All eyes are on the AI trade, but the best performing IPO of the year has nothing to do with AI. It's a biotech developing a hair loss drug, Veradermics, up more than fivefold since February, and it's in good company. Biotechs dominate the year's list of best performing IPOs, even while the flashier names have stumbled. So the big question is, why is capital quietly moving from AI to drug development? Answer it before you touch anything else going public. Hey, welcome to New Stock Signals. I'm Bill Smith, founder of Renaissance Capital, which for over 30 years has analyzed more than 11,000 IPOs. I read every comment, so be sure to share your thoughts below. Nothing in this video constitutes personalized investment advice. Always consult your own financial advisor before making investment decisions. This isn't a story about one drug or one lucky stock. It's a story about rotation, money moving from where it's crowded to where it's mispriced. If you own AI names, you need to understand this. If you've written off biotech, you especially need to understand this. By the end of this video, you'll see how one sector went from ice cold to white hot. Then you'll know how to filter the real opportunity before the next winners become headlines. Let me take you back. In 2020 and 2021, biotech went insane. More than 170 drug developers went public. Almost every single one was pre-commercial. Many had barely any human trial data at all. Think of it like a party where everyone got in, regardless of whether they belong there. And you know how those end. By 2022, the music stopped. Stock prices collapsed. Investors fled. Last year, only 12 biotech companies managed to go public in the entire year. Biotech didn't slow down. It shut down. So when I tell you the window's open again, understand what that means. This is a sector coming back from the dead. And the way it's coming back is what matters. The 2021 boom rewarded stories. This one is rewarding data. Let me be clear about the difference. In 2021, a company could go public on a pitch deck and a dream, a platform, a theory, no proof required. In 2026, the companies getting out and staying up have something the 2021 class didn't. Clinical data in hand. Look at the numbers. Over a dozen venture-backed biotechs have priced IPOs this year. Proceeds have topped $4 billion, more than 3 times last year's. And most of them are trading at or above their offer price in a market where some of the biggest IPOs have struggled. You need to get why that gap is important. The last boom was a lottery. This one is a filter. The market is being selective. It's paying up for proof and punishing everything else. No exuberance, just discipline. And discipline is exactly what you want to see before you get interested. 3 things you need to do with this before you look at any IPOs. First, stop thinking in sectors and start thinking in flows. Capital doesn't disappear when a trade gets crowded. It rotates. Right now, some of it is rotating out of overextended AI names and into healthcare. Valuations in this space reset years ago, and the fundamentals are catching up. You don't have to abandon AI to see it. You just have to stop assuming the whole market moves as one thing. Second, understand the filter is the strategy in biotech. Don't ask about the story or the platform when a drug company goes public. Ask, how far along is the lead drug? Early stage science is a coin flip. Late stage data is a different animal. Ask, who's running it? Several of this year's winners are led by veterans who built and sold drug companies before. It's not a coincidence. Ask, is there real clinical data or just a promise? Proof beats promise every single time. Third, watch the lockup. This is where most people get hurt. When a biotech goes public, insiders can't sell right away. But when the lockup expires, large blocks of stock can hit the market. Post-lockup selling pressure can knock down even a great company. Know those dates before you buy. And the mistake to avoid? Don't chase the Veradermics of the world after they've already gone up fivefold. The framework is the opportunity, not the headline. Now, let me be honest with you. It's more important for you to trust me than agree with me. How do we know this isn't another false start? The honest answer is we can't be certain, but we can read the new stock signals. In 2021, more than 170 companies got out. This year, it's a couple dozen. The gate is narrower, the bar is higher. Even the people cheering this market are careful. One banker called it the healthiest biotech IPO market in a long time, but nobody who's serious expects it to hit 2021 volumes, and they shouldn't want it to. Second honest point, not every one of these is a winner. Several 2026 biotech IPOs trade below their offer price, but that's the whole point. A selective market separates winners from losers. Your job is to be on the right side of the line, not to assume the whole sector floats. I'm not telling you biotech only goes up. I'm telling you the conditions are healthier than they've been in years. Those are different claims. Hold them carefully. carefully, so let's bring it home. The best IPO in the U.S. this year came from a sector most investors weren't watching. It came from rotation, not luck, and it's rewarding proof over promise. The lesson isn't buy biotech. The lesson is money moves when a trade gets crowded. The investors who win are the ones filtering for data, teams, and stage, while everyone else chases the last headline. This is what we do here. We don't chase noise. We build a system that still works when the noise fades. If you want more of this kind of thinking, subscribe, like this video so more serious investors find it. And if you want the framework to analyze every IPO from neoclouds to next-gen drugs, it's all in my book, The New AI Stock Edge. Pre-orders are linked below. In this market, the edge isn't finding the hot sector. It's knowing how to filter it.